Hey folks, Larry Berman here. Late Friday, market's about to close in about 10 minutes. I got my drinking shirt on for the weekend. Going to a concert tonight. Anyways, it's that kind of week where you want to have a little nip at the end of the week to kind of ground yourself here. Beginning of the week, markets are looking great. We've been cautioning for a couple of weeks now not to buy into the hyperbola here about everything's good and risk on. And as we end the week, the charts don't look so good and maybe a little bit of risk off. I feel like I need a clown nose on, to look like a meme, in the sense that the volatility, if I look at the active list today and where all the volume is, it's every single meme stock you could possibly imagine, from DraftKings to Bed Bath and Beyond. I don't think any one of these Reddit traders that are trading that stock has ever been into a Bed Bath and Beyond, but that's a whole other story. So let's have a look at the charts this week and see what's on my radar. So most of Friday and for the most part the last couple of days, headlines like this, when we look at what are the Fed guys saying. Barkin said today the Fed will curb inflation even as risk of recession. And, Bloomberg's writing stories like this. Fed speaks foreshadowing, recessions and so forth. So if you look at the MOVE index, if you're familiar with what the MOVE index is, it's the VIX of bond market. And if you look at what's gone on here, certainly this week, what you've seen here is a spike up, not to the extreme that we saw in July, but a rise in interest rate risk. So what does that mean? Okay, so let's look at the various inflation metrics. So this is a 2-year inflation index swap against the zero curve. What does all that mean, Larry? Well, essentially it means expectations of inflation 2 years from now. And as we've seen in the last couple of weeks, under control. If inflation expectations if this was happening, that was happening, war breaks out, and the Fed isn't responding, this would be shooting up. The fact that the Fed is painting a more hawkish picture is why this metric is contained. And that's good news. We want the Fed to be hawkish. We want inflation to be contained. We don't want it to run away. That is the more worst scenario. What does that mean for risk assets? The longer duration, as QT starts to ramp up in the next few months, we're most certainly going to see the 10-year test 3.5 again. So what does that mean for risk premiums? Well, where were equities in the middle of June when the US 10-year was testing 3.5%? Sure enough, back at the lows. So when we look at this week's candlestick chart, we look at a test of the 50-week average. On the dailies, the 200-day average, we look at a reversal and a failure there, lining up for Jackson Hole this week. It's all spelling, let's see a correction of risk markets. Powell will not likely indicate a Fed pivot of any sorts. And as Fed rhetoric this week has concluded or suggested, that even at the risk of hurting the economy, they don't want to, but if they have to, they will, to make sure inflation expectations remain contained. And again, bond yields going up. So that's the scenario this week. Nothing's more important. Frankly, this weekend I've got a golf match on, and if I win this, I'm going to go to the finals. So, Cahal, I got my finger pointing at you this week. So um, bull and bear pick of the week. On the bullish side, there's not a lot that from when you look at what do I want to own now. So the defensives are interesting. What we're accumulating a little bit of today is some TELUS in the U.S. Again, very nice dividend, big gap down a month ago. Risk return, looking at a 5-year lens on the stock. It's not a growth story, but again, for defensive investors out there, where are you clipping a coupon? This is a nice place to sit if you want to be in the market. If you want to be in cash, then go ahead. But you got a very nice yield here, and from a 5-year picture, risk return looks pretty attractive here. Now, what is AT&T worth? Well, mid-20s for sure, I would think. And in the best case scenario, looking a couple of years out, back to the upper 20s. Very, very nice risk return here for a name if you're looking for something to buy. What don't you want to own right now? Pretty much anything in this ETF. This is where the bulk of the correction is on valuation if we're going to see interest rates tick up again, and that is the call. So, look at what's underperforming dramatically on the day. It's the weaker earnings names, generally speaking, in the NASDAQ. So, bear pick of the week would be caution on the markets overall, but really, if you're looking for something to short, PSQ or a leveraged play on the Qs, for the fast market guys would do it. And for the conservative investors, look towards higher yielding stocks that have already come off quite a bit as a place to park your money for a while you're waiting for an opportunity to get back into growth. Is it September, October, or is it sometime after the election? To be determined, but that's what's on my radar this week. Have a great weekend, everybody, and enjoy what's left of the summer, because Powell is going to take the punch bowl away this week.